Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. Hey, everybody. Welcome to Options with Hans. I am Hans Albrecht. I've spent 30 years in the trenches trading options, from market making, floor trading, to managing income funds, $1 billion managed, including 10 income ETFs, and 2 Black Swan defensive strategies that protect against crashes. So offense and defense, you just can't step on the gas all the time. You have to be careful and prudent as well. So that's my thing. That's why so many people have come to me after wasting time and too much money on the wrong approach. So check out my testimonials at optionswithhans.com on the mentoring page. And let me tell you, in today's chaotic markets, you are gonna need offense and defense, right? Having done this for 30 years, I'm not that surprised. Every now and then the market just gets tough. It usually happens after a period of it being really, really easy, right? You think back to July, June, the first half of 2024, very easy, straight up. Nobody was buying protection. Skew, that downside put skew, really, really cheap. Nobody needed protection anymore, right? And then suddenly that happened. And then again this year. So if you have the right tools, you're going to be in the driver's seat instead of just a passenger. My MTI indicator flashed total red at 59.97 before the S&P dropped about 1,000 points. Of course, I didn't know the S&P was going to drop 1,000 points, but the right indicator can get you in the right lane. And that's the thing about trading. You've got to recognize when risk is starting to overcome reward. And that's exactly what happened there. So you can see that, and mind you, I am a bull much of the time. 2023, most of 2024, bull. What happened? December 13th, I put out a YouTube video. You guys can check this out. The link's right there. Market crash. There are signs. What was the market doing at the time? It's almost sitting at the all-time highs, like right around 600, yeah, right around 600. So pretty darn close. Then we got this 300-point sell-off. What did I see? Well, there were things brewing below the surface. And so when you become a better volatility trader, and if you're an option trader, you're a volatility trader, whether you like it or not, you're trading sentiment, you're trading fear and greed and all that kind of stuff. You need to kind of know those signals, things under the hood that are going to start giving you an indication. And that can be important with equities, because equities can kind of be like, la, 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 we're not seeing what's going on here. They're sometimes really late to the party. That's to our advantage, right? Because we start to see those signals, VIX futures, things like that, that start to give us an indication that stress is rising. Stress is rising. So video then things started to rally back, of course, and then we hit those all-time highs, started to come off, and then the tariff stuff really started to go. And so on this show, Feb 26, I said, I turned to the dark side. That's what this title was. Hans turns to the dark side. It was such a big thing that that's what they titled it. So we do this show every week. And basically, things started to look pretty bad, right? I'm a big bull, but things were starting to break down. There were a lot of concerns. I saw a lot of sort of exuberant behavior, a lot of foreign money coming in, a lot of retail money coming in, like really kind of almost parabolic style excitement about stock markets. And when that happens, there aren't too many people left that need to get bullish, right? Everybody's kind of on one side of the boat. So I've seen a lot of bear markets, and you don't always see the signs, but you can start to see one of the things that you get good at as a volatility trader, as a good options trader, is you start to notice things starting to get a little bit incrementally worse over time. And that's what tells you to just kind of dial back your risk and start to maybe consider doing other kinds of trades. And that's what my systems are all about. There's a time to really press on that gas pedal. There's a time to sit on your hands. And there's a time to kind of, do those more income-y type things that can take advantage of the right kind of neutral type environment. So if you're new here, check out my other videos. I think you're going to walk away learning some interesting things. So today I want to show you one of my all-time favorite tools in markets, options that are called LEAPs, right? That stands for long-term equity anticipation securities. And that's a complicated sounding name, but stay with me here. It's not that tricky. And this could really be one of your best tools, period, that you could learn. I promise you, if you're of a certain vintage, you might remember a show called Quantum Leap. And it was this show about time travel. And this version of Leap can actually help your account take a big leap forward over time when used properly on the right stocks. And this is very much a part of my community. In fact, my hedged Leaps income portfolio is up, what is that, 18.5% this year, with the S&P kind of unchanged, the NASDAQ still down, what, maybe 5-6%. So doing really, really well, including a number of hedges, right? So it's called hedged income Leap portfolio. So we do income, we do hedges when it makes sense, when the hedges are cheap, when not necessarily, sometimes when the hedges just make sense, right? Not always when they're cheap, but when it makes sense. When the roof is on fire, you better make sure that you're steering in the right direction, right? So, and so you can see here, we would have been up about 15%, but we added another 3.5% to that through a number of different kinds of hedges. So, in my view, I think, leaps are kind of in addition to a lot of things that I do. But I think that they really bridge that divide between the advantages of options and the longer term views that you may have as an investor, right? So I think they're actually kind of a good way to start in options. Some people might think that's a little crazy, but why not? You get a lot of those positives from options. We're going to talk about those in a moment, the leverage, all that kind of stuff, but without some of the negatives necessarily. So check out the service in the description. Hedge Income Leaps Trader is going to be a standalone service soon, and so you'll be welcomed into that if you want to be a part of that. And I can't show you all the names here. We do have one stinker. Actually, we've got a couple of them going against us. I'll tell you one I got out of Google, and for a lot of reasons, if you've been watching my videos, another one's down. Reddit I got down a little bit, but a lot of really good ones, right? I think we've got 4 or 5 names that are actually hitting new all-time highs, right? So you really want to pick those names with the good stories, et cetera. So that's what we really focus on. You can't get them perfect, but the idea is that you have we've got about 20 names here, and overall doing really, really well. Okay, so let's talk a little bit about options in general, because I've experienced this over the decades, and it's pretty incredible what's going on out there. Most options traders focus on short-term options, of course. Zero DTEs, as we can see, those are options expiring today, right, the same day, have really exploded. Look at that graph from 2012 all the way where we are to where we are today in terms of the market share of total options traded. It's quite unbelievable. Over 50%, right? If we add full 2024, well over 50%, I think it hit 56, 57% of daily option volumes are zero DTE, 0 days to expiry. This is partially maybe a bit of targeted hedging, right? So we have these tools now to kind of get us through a day or a period of a few days. Sometimes if you're trading, a few day options, but generally speaking, I would say I'd put this kind of in the category of gambling and coin flipping. I'm not a massive fan of these things. If you're really dialed into day trading tick by tick, you're watching all these unique indicators, gamma indicators, maybe they can work for you. But think of leaps as the absolute opposite of this, right? They are long-term options, typically expiring in 12 to 36 months. So between 1 year and 3 years, right? Some people consider 10-month options leaps, whatever. If the technical definition is 12 months, we'll leave it at that. So now, they're very, very powerful. When you think about it, when you trade options, particularly from the long side, we can't control markets, but we can control how much time we give ourselves to be right. So the leap is very powerful in the sense that we give ourselves the chance for our thesis to play out. Now, they cost certainly more than a 1 or 2 month option, but you give yourself a chance, right? How many times have you bought a call and seen it just kind of go to dust, and eventually the idea that you had sort of came to fruition? That's really, really frustrating. So one of the things that I teach in the long options game is give yourself enough time, right? You can't control much. At least use the one thing that you can control. So benefit, time to be right. I can't emphasize that enough. Number 2 is kind of tied into number 1. It's the preservation of emotional capital, right? That freedom from the pressure of having to be right now, right? You have to be right now. You have to be right on direction when you own options. That lets you think more clearly, and that's really underestimated in terms of the way people go about their business of trading. You want things that help you think more clearly, that allow you to step away and observe and strategize, plan, and act more like a rational market participant as you look at the bigger picture. So that's what kind of excites me about trading longer term options in general. At least, if I'm playing like a big swing trade, at least give myself 4 or 5 months. But these are a very different kind of purpose, right? So we're going to get right into how I choose them and why in just a moment. Okay, so what can you do with leaps? Great question, right? What can you do with leaps? These are longer term options. So you can do some of the things you can do with shorter term options, but not, you shouldn't do certain things that we do with shorter term options, in fact. Leap puts, okay? So people don't use leap puts very much, but these are really mostly used, in my view, for downside protection, right? So in my black swan funds that I ran millions in these black swan funds that basically protected against downturns in equities in the U.S. and North American stock markets. I use these for basically shoring up that downside, right? Giving people this ability to sleep at night because they knew that below a certain point in a sell-off, you were going to be protected. In fact, in these black swan funds, I would kind of juice them up a little bit so you'd actually potentially make money in a catastrophic move down. So they can be very useful depending on where the pricing is, right? That's what's very, very important. So, at certain environments, VIX makes more sense. Certain environments, S&P downside makes more sense, or IWM or QQQ. So you kind of want to know a little bit more under the hood of how the volatility products work. Not important for us today. Leaps calls is what we're talking about today. This is where it gets exciting for us as long-term equity investors. They're a kind of stock replacement type strategy. So you can control upside in a leap with a fraction of the capital required own the shares outright. This is really the primary value with what we're going to explore here. Now, there are guardrails, of course, that we need to adhere to, and some myths and things that people say out there that I don't agree with necessarily, and that some of them are just wrong. But we can go over some of those as well. Now, can we use leaps for income trades? Not really per se to the income portion of the trade. You're not going to really want to sell options that are beyond 6 months, in my opinion. You want to kind of focus on that shorter part of the decay curve where you have that ability to sort of see theta work for you, see the passage of time work for you as those options decay. But for leaps, I've heard of people selling, like a 1 year option with, 2 year option. You're just not really positioning yourself very well in a product that really, in my view, has this kind of embedded edge in playing the long-term uncertainty and what's going to happen, right? So the reason that the delta in a leap tends to trend towards 50, no matter where it is, it kind of trends towards 50. If you kind of learn a little bit about how the Greeks work, that just means that, over a year or 2 or 3 years, 3 year option, it's a bit of a coin flip, right? Like it's a bit of a coin flip. Anything can happen in that period of time. So they really don't lend themselves to income trades. Now, we're going to do it in another video, but these are going to be used in a way to set that core foundational long view in a stock. And then we can overlap that with some income trades, right? So that's something you called diagonals or called poor man covered calls kinds of strategies that you can actually supplement with income type trades, which is kind of cool. So let's look into what these leaps are. I'm going to tell you exactly how I set them up, what I'm looking for, what delta, etc. We are looking at something that really just looks like a long call, right? It's just a long lifespan call. And so basically, whatever you put into a long leap is your maximum loss. So you're on the right side of leverage, right? You're buying something for, let's say, $20 that could turn into 60 or 80 or $100. That's sort of the beauty of being on the sort of positive side of leverage. So it looks just like a call. You've got this cost here at expiry. This is your expiry line, which is not going to be your everyday line, your sort of real-time T=0 line, but you're going to have this basic look at expiry, which is, past your break-even point, your strike plus your premium. You're going to start making some money, right? That's where you're gonna have the benefit of that leverage that gives you a control of 100 shares with one contract. Below that break even, you're going to give back, and then below the strike, you're going to have that maximum loss. So this is something that we are going to relegate to very, very strong ideas, quality names, the stuff that I talk about in all my programs, the sort of foundational pillar of the really what you should be looking at with all kinds of option strategies, but in particular for leaps, right? So I kind of reserve these for sort of my top quality names, narrative, storylines, fantastic balance sheets, perhaps something that could be a little bit more growthy but has a real explosive potential, but I would keep that to a smaller portion of my portfolio. The bulk of these are going to be in really, really good ones, right? Like I mentioned Reddit earlier. That's a small portion. I would never put a large amount of money in that personally. Somebody might, but personally, I'm going to be in the Metas, in the Amazons. I'm going to be in the really, really solid stuff with these kinds of trades. And then for a portion of the portfolio, I might be in some Teslas, some Reddits, certainly something like a Hood that I just feel very, very strongly about. So there's some great names out there, Ubers, those types of names that I think have that, Uber's kind of like, it's sort of in between, right? It's great growth, amazing cash flow, but sort of some uncertainties surrounding it. So with these kinds of strategies, we want to focus really on those high deltas, right? Because this is really just something that we're going to be using to replace stock. Okay, so number one, we're going to choose an expiration that is 12 to 24 months out, right? That makes sense. We talked about how these are longer term options. You can go out 36 months. I prefer to kind of keep it in under 2 years just to keep the price a little bit more reasonable and to kind of pick up one of the primary benefits of leaps, which is lowering that time decay, right? So you can see, we call this theta as well. You can see that time decay in an option goes down and down and down. It starts to accelerate as you get closer to expiry, right? Because that extrinsic value, that time value, has to be zero on expiry. So the way that this works is that the longer term the option is, the more this rate of decay kind of flattens out. So on a leap, you're way, way, way over on the left here. I'd probably have to move this over here. You'd be way, way over here in an area where there is a little bit of decay, but it is very minimal. At that point, you kind of have a bit of Vega exposure, which we'll talk about in a moment. But in terms of that time decay, you're positioning yourself in something that isn't decaying very, very quickly. Number two, strike price 10 to 20% of the money. Okay, so I don't like this. I've seen this around. We'll talk about how that strike should be a certain percentage in the money. And I don't think that's a great way to choose your strike because it sort of paints all stocks with the same brush. And stocks have different behavior, different volatility levels. Tesla is very, very different from a J&J. And so what I prefer to do is use a delta. So I'm going to show you this in a moment. Delta between 70 and 85. So that's going to be an in-the-money call that is acting quite a bit like the stock. The higher the delta, the more your call is going to act like the actual stock. A 70 delta means that for every dollar move, that option is going to move about 70 cents. So if you go for an 80 to 85 delta, that means that option should move about 85 cents for every dollar up or down that the stock moves. Now, this is going to be a moving target as well, right? So that delta is actually, as the stock goes up, is actually going to rise. So you get to a point where the delta keeps rising, rising, rising towards 100, where eventually it's going to start to act pretty much one for one like the stock, which is what you want when you have this long-term view of the stock. So you're going to buy a leap call with that high delta for that stock-like movement. That stock replacement strategy involves getting that higher delta. I've called that hard delta, right? The soft deltas, I don't like buying sort of 20 delta, 25 delta. Don't get me wrong, that if you really, really have a strong view that something is going to really, really go, then by all means, it's not incorrect to do. But for me, I like to get that strong delta that isn't subject to what soft deltas are subject to, which is basically a drop in volatility, a little bit of we call those the wings. They kind of collapse a little bit over time. So they may not act as well as you think they will, but there's no question you get a lot of leverage out of those low delta options. For me, this is more about grabbing a call that's going to start to mimic the stock at a much, much lower cost. That is really the primary value in leaps for me. So I want to show you how this looks in reality. So we talked about buy a leap 20% in the money or use a delta. Well, this is why I use a delta, because delta is a moving target. So as implied volatility rises in an underlying stock, you're going to see that the delta moves around. So the nice thing about picking a delta is that it evolves with the volatility of the underlying. It's not going to be the same for one as it is for the other, and it's going to change over time, even for one specific stock. So look at J&J. With the stock at $151 and at a relatively low 21% implied volatility, that IV, The 80 delta, which is something I would target personally for a leap, is 4% below the stock price. So we look at the 80 delta here, it's the 125 strike on the June 2026 expiry, which is a little bit over a year away right now. And you can see that at this implied volatility, we're about 4% below where the market is trading. Well, let's take a look at Tesla, which is a $350 stock price. And remember, it has nothing to do with the stock price itself. It has to do with the implied volatility, which is measuring the relative cost of those options, right? Sort of like, are you insuring a 20-year-old driving a Ferrari, or are you insuring a 55-year-old lady driving a station wagon? Those are going to involve very different implied volatilities. You're going to charge a lot more for that young man than for the lady. And that's exactly what you're seeing in stocks, right? So Tesla has the tendency to move around and be volatile. It is going to command a relatively higher implied volatility. So let's look at the 80 delta. Remember, we're comparing 80 delta to 80 delta. And in the case of Tesla, that delta is 25% below the stock price. From 4% below the stock price to 25% below the stock price, Tesla. So really, it is evolving with the underlying. Now, if Tesla's implied volatility drops, then you're going to see those deltas come back, right? The out of the money deltas are going to come back towards this to where the stock is trading, and the in the money deltas are going to come back towards where the stock is trading. So the idea is that this 80 delta is that it's the idea with delta in general, targeted delta, is it's going to incorporate movement underlying. You don't want to sell a Tesla option at a 21 implied volatility like on J&J, because that could move to that strike price in an instant. Whereas on J&J, it's going to be slow and steady, very little breakneck movement. I much prefer to target that delta instead of the in the money, that sort of moneyness. So next, we want to check the implied volatility, but I think people do put a lot of emphasis on this, sort of for good reason, but maybe not really kind of, understanding the way that those longer term vols really move around. So when you're trading 1 month, 3 months, 5 months, 6 months, absolutely that volatility risk, which is the risk of relative option pricing moving around, that implied volatility going up or going down, that's called your Vega risk. And so that's what people are talking about when they deal with this. So the longer an option's lifespan, the more Vega risk it has, right? So a 1-day option is going to have very little Vega, and a 2-year option is going to have a whole bunch of Vega. But the thing is, at the long end of that term structure is basically just we're saying, those very far out expiries, the 1 year, 1.5 year, 2 year, most certainly, those ones don't really move around very much. When things get scary out there, people want to play the front one. They want to get into protection right away. So they're playing those front month expiries. The back ones can move around, but not that much. And I think that's where people kind of overstate the sort of risk in a position that is 12-month, 18-month, 2 years. So if we let's take a look at Meta here. We can see that these shorter term options, this is your short-term 30-day volatility chart. You can see in the gold, we'll hide the historical volatility. So look at how they move around, sort of from the 24 rate down in around 24, 25, all the way up to 60 plus. But really, the realistic range is kind of from 24 to say 50-ish. That's a pretty big range, right? That's a double of implied volatility. So you can see that those short month options really swing around in terms of that implied volatility. Now, let's look at a 120-day option. So this is going to give us a little bit longer term option, and you can see that it doesn't swing around quite as much. And if you look at the scale, you'll notice that it isn't very much. Maybe we go from between 35 to maybe 38, 39. Now, let's look at 720-day volatility, so 2-year options. Now, we obviously have like a little bit of a gap in data here, something missing, but you can kind of see that even though you're seeing these little ebbs and flows, the reality of it is that it really trades between kind of 34 and what is that, maybe 37, around there. So absolutely, you do have some Vega risk, meaning if you buy a really high volatility, maybe it can come down 3 or 4 vol points. But what I want to impress upon everybody is that really what you're trying to do here is you're trying to understand what you're doing, so where that torque is coming from. Let's kind of experiment. So we just had Meta was down around, got down under 500, but let's say we looked at some leaps around 530. It's starting to, double bottom, starting to act well again. I'm not going to pick the bottom here, cherry pick. I'm going to say, look, it's starting to look interesting again. You can even pick this day here. So 549, right? It starts to break out, comes back down to 540 or so. So 540, let's say we bought a single 80 delta call in June 2026. So that's a little bit over a year. And you sort of go, okay, well, I've got a little bit of Vega risk, but we just looked at how long-term option pricing works. That doesn't really swing around very much, right? You might have 3 or 4 points of volatility risk. Points means if the volatility drops by 1, if the implied volatility drops by 1, you're going to lose $180. If it drops by 2, you're going to lose 360, so on and so forth. But if you had bought, but what you're much more interested in a big sell-off like that is your delta. Your delta is you're long 80 deltas. So even though you have this Vega risk, you know that if Meta rallies, it's going to give back a little bit of that, but it's going to be very, very small in comparison to what you're going to make on the long position, right? So people who say, well, don't buy leaps when the volatility starts to get really, really high, it's probably really, really high on a quality name that isn't in the midst of some sort of severe fundamental idiosyncratic kind of problem. It's down because the market's really, really sold off, but you're not in this for a small win. You're trying to make some real upside. So if the stock goes up $100, you're going to make about $8,000 on this particular option, right? So you've got $17,000 invested. Maybe the Vega drops 3 or 4 vol points. Who cares? So you can lose like $700 because the volatility came down. So my point is that I really don't think that the volatility is a really, really big impediment to using leaps. Of course, you want to try to avoid buying the absolute high of the range, the 52-week high. But generally speaking, I showed you that those option prices don't really move around very much. The front ones can move around 10, 15, 20, 30 implied vol points. The back ones might move around like 3, 4, maybe under extreme circumstances, maybe 6, 7. So you have to think of what Greek is really in control here. And you're getting into a trade like this for its stock replacement value. You really want to see this thing go up a good amount. You're not really flipping this thing around. So you get 80 delta, that's going to far overpower any sort of drop in implied volatility. And if the stock doesn't really move very much, the vol might come down a little bit, but not very much. So you just have to kind of understand where that torque is coming from. So in this particular case, I don't think we're that concerned about Vega. There are other strategies that we talk about where the Vega is really, really important. It's actually part of the strategy is to have an expectation that volatility is going to come down, that Vega exposure. But in this case, I wouldn't worry about it too much because it's a Greek that doesn't play into this too much, even though the textbooks will say, well, yeah, the longer term options have this massive, massive amount of Vega. But what they kind of don't mention is that, well, those longer term options tend to not really move around very much. It is possible that something just kind of gets reset to a much, much lower level at some point. But generally speaking, it's not in reality, in practice, it isn't really a huge issue. And when that volatility soars in the long months like that, in the long-term expiries, it's usually because the stock is really sold off. So for example, Meta just went from 740 to 480. Yeah, but now you're getting into something like this for the delta. You want the exposure to stock-like performance that you're going to get from the leap, and you're not going to worry as much about those 3 or 4 volatility points that you may lose on the way up. So implied volatility, not a massive to low, is better. We prefer that. Or when it gets super high. So when I see that IV percentile above 90, the market's probably getting a little bit washed out. That might be where option price is just slightly a little bit more expensive. But again, for all the reasons we just talked about, not really a big deal. So with leaps, you don't get the dividends. So that if people sort of talk about how that's a really big negative, it isn't really an actuality, right? You don't get the dividends but the dividends are baked into the option price. So I've prepared a little example here. I've shown you Apple. Let's say we assume this is on a 486 DT option, so very long term. We can see that if we have 0 dividends on Apple, the 180 strike, which is well in the money compared to the current stock price of 206, is priced almost at $50, 49.72. Let's make that dividend 4%. Let's give that a 4% dividend yield on Apple. And we can see on the exact same option, the option price goes down to 41.81, almost 42. So that's a big difference of $8. And the reason for that is the formula, the Black-Scholes or whatever formula you're using, is including carry. So it's including carry costs as well as dividend costs. So the dividend cost is a higher dividend is going to lower the price of the call. So yes, you're not getting the dividend that you would if you own the stock, but you're getting to play the leap game for a lot less money. So this is incorporating a whole bunch of dividends, right? So the dividends are basically getting extracted from the price and giving you a really, really nice low price to give you a little bit of cheaper convexity, right? So don't think of it as losing something because it's a bit of a swap. You're kind of giving up a dividend now. There may be tax implications for you, et cetera, depending on where you are in the world. But think of it as just kind of giving up dividends to get a cheaper way to play a leap. So next, plan to exit or roll early. Well, that's a good thing to keep in mind, right? So when you buy something, it's a year and a half, or maybe a year, 12 months, 13 months, 14 months. You want to avoid that steeper area of the decay curve, right? So one of the big pluses with owning leaps is that you don't have to deal with that expensive daily decay of the option because you're just so far out that it doesn't figure into the equation very much. Now, when that option does become a 6-month, 5-month, 4 months to remaining option, now you're going to start to have to deal with that, right? So if you want to continue, of course, you're going to assess where the stock is, how you feel about it, how you feel about the market. But if you still feel the same way, I would recommend that you roll it with about 6 months remaining. So if you buy an 18-month leap and it's doing something for you, or maybe it's doing some of what you were expecting, I would roll that out to another 18-month leap with 6 months remaining, so you can kind of stay on that happy part of the decay curve. So again, don't hold deep into the final months when theta decay accelerates. Okay, so now sizing the position. So I've heard people say, like, don't put any more than 5% or 7% or 10% in leaps. For me, it really depends how you're approaching leaps. If you're buying a whole bunch of 20 delta way out of the money calls, then yeah, you want to be a little bit careful because those are, again, what I call those soft deltas, maybe subject to compression, pricing compression, volatility compression, et cetera. Certainly the passage of time, those out of the monies are going to get hit a little bit harder earlier. So you do want to stay conservative if you're playing leaps in that way. For me, because it's a stock replacement and I'm targeting around that 80 delta, for me it doesn't. There's really no and the next point that we get to is going to be important because I'm saying that you don't have to stick to a small allocation. It can be a big allocation as long as you don't lever up. Okay, so I've put this in red here. To stay conservative, only invest 25 to 35% of what you would have invested in the stock. And let me show you an example of how that works. This is a really crucial point. So when we talk about how much to invest in leaps, you can basically replicate what you would originally have put into this. So when you sort of go about looking at your portfolio mix and allocation, and let's say you have a $100,000 portfolio, you're going to put 10% in each stock. Just for example, you might only put 5%, whatever it is. Let's say it's 10%. So you can put $10,000 in Hood, or you can try to replace that with one of these in the money leap calls. So if I go down through here, you can see the 81 delta, the 79 delta right here. So between the 81 and the 79, let's just say we pick the 79 delta, that's going to cost me $25 instead. So instead of paying $64.70 for 100 shares of Hood, I'm going to pay $25.75. So let's take a look at that math in a moment. 25.75, it's less than half, right? And you can control the same number of shares. This is going to control 100 shares. Of course, right off the bat, it's not going to move exactly like 100 shares because it's a 79 delta. So it's going to move about 79% of the movement to the upside in Hood. Now, as Hood starts to continue to go up, let's say you're right and Hood goes to 70, 75, 80, continues to do well, this delta is going to rise. It's going to go to 85, 90, 95. Eventually, it's just going to act just like the stock. It's going to go up one for one, $1 for every $1 move up the underlying stock. So let's take a look at the math quickly on this, just to kind of drive home this point that we've got to be very, very careful. This doesn't mean we can suddenly allocate a whole bunch more. So 100 shares of Hood would cost us about $6,500. One call at the 79 delta will cost us, what was that? Let's look over here, 79 delta, about 26. Okay, so let's say 26.50. So it's going to cost us 26.50 instead. So 26.50 is about 40% of the stock purchase. So really, this is what you're achieving here with the leap. You're achieving a very similar kind of exposure to Hood with a lot less money. Now, of course, there is some time value here. So there's no question we have to take into account the fact that this has about $10 of intrinsic value. There's no question that that is a lot of time value on a stock like this. Now, this happens to be a higher implied volatility stock. It trades around a 70 implied vol. That's a lot higher than like a J&J, as we were talking about earlier. So, you're paying to play a little bit here because Hood, in my opinion, is a stock that could be $100, maybe higher, over the next year and a half or 2 years. So you're definitely paying a little bit more. Now, what you want to be careful of is the whole idea is if this stock fails and you own this call, you don't want to lose a whole lot more than what you normally have lost, what you have normally lost in the stock, right? That's kind of how you have to think of this. So if Hood goes down, let's say Hood goes to about $30, it's going to lose about half its value, and this thing goes to $30, you're going to lose about, your $26, whatever it is you put in there. Okay, so you're going to lose less than you would in the stock. But let's say they both went down. Let's say Hood went down to $40. You're going to lose, ultimately, this is going to hold on to some value, of course. If there's lots of time left, there's going to be time value in there, even if it's out of the money. But you kind of don't want to lose more than the stock. But it does have this built-in hedge, right? You can only lose $26, whereas if Hood goes to $20, you're going to lose $45 in the stock, but you're only going to lose $26 on this one, right? So it has that embedded hedge. And in the money leap, basically you can almost think of it as like a synthetic stock married put, right? So it's kind of like long the stock plus a put. It's an out of the money put. It's really kind of the same thing, right? So it kind of limits your downside beyond a certain point as the stock goes down. So what I'm trying to get at here is you really want to take part in something like this because it gives you the leverage, but you don't have to put as much money. You can put instead of investing $6,500, I can only invest $2,500 or $2,600, and I can put the extra $4,000 aside. And if there's a big market sell-off, if there's something happens out there, now I have cash, I have liquidity to be able to react to sell-off. So that's a really kind of the secret weapon of the leap, is that you can really get things done for a lot less, have that liquidity available to do other things with. You can sit on it, make risk-free money, whatever it is, but you're sitting around with this cash, and that represents dry powder if the market really, really sells off. So what I don't want people to do, and I'm not telling anybody to do anything, but what I've told students is, listen, don't look at this and go, well, it only cost me $2,600, so I can buy 2 or 3 times as many of these. That is called levering up. So if I buy 2 of these, I'm going to spend about $5,300. But I'm now levered up. I now control 200 shares of Hood. And what does that mean? Well, if Hood goes down to 40 bucks and these expire, I'm going to lose uh, all of this money, right? I'm going to lose this $5,300 instead of what I would normally lose on Hood, which is about $2,500. So do you see that? If Hood goes down, the more I add to these, if I added 3 leaps, if I said, well, look, I can control the same amount of Hood as I would if I bought 6,500 shares. Why don't I buy 3 of these? Only cost me 7,500 bucks, right? Let's say it cost me 7,800 for 3 times the amount of Hood. Why wouldn't I do that? Well, you wouldn't do it because if you originally wanted to put $10,000 into this thing, if Hood goes down and has a bad run for a little bit, you're going to lose a good chunk of your money, and these are going to expire, or they're going to go down to almost nothing, and you're going to lose a big chunk of money. So the intention of this part of the video is that I don't want people to think, well, I'm going to just go all in. Leaps cost me a lot less, so I can uh, basically own 3 times as much of the underlying stock or 3 times as much of the market. That is a very dangerous way to look at things. You want to set these up because they allow you to accomplish your exposure that you would normally have in the stock for a lot less money, and allows you to have that extra protection, right? All I can lose is 2,600 bucks on this. Hood could go to 20 bucks. If I own the stock, I'm going to lose $45 on the stock. Here, I'm only going to lose $26 because that's all I put into it. So you can control the same amount for a lot less money. Plus, you have an embedded hedge in there. You can only lose what you put in. And that's really the beautiful advantage. You've got this cash sitting on the side versus having invested the whole amount in the stock. That doesn't mean you can suddenly say, well, now I can own a whole bunch more Hood. Now, I'm not saying that's always wrong. If you have once in a while, if you have some absolute incredible premonition that something's going to happen and you really want to go for it, it's your life, it's your money. Do what you got to do. But I want you to understand the distinction between using leverage properly and more conservatively, and really, really kind of levering things up because of that leverage that you get. Okay, so that's a really, really important point. I know I took quite a bit of time saying that, but I think it is important. So one other point that I often see kind of pushed out is avoid earnings before, when you're playing leaps. So trying to buy leaps right before earnings events. For me, it doesn't make too much sense. I mean, do I want to buy a leap right before an earnings event? Maybe, maybe not. But I mean, you're buying leaps basically that are going to last you a year and a half. You're going to run through some earnings events, right? So this idea that the post-earnings volatility crash is going to hurt a leap's value isn't very correct. It's going to be very, very minimal, if at all, because as we talked about, the far end of that term structure, where those far expiries are, really don't get affected by so much. The price of the stock can move around, but in terms of the volatility, the option pricing, really not very affected. So you have to understand why you're getting into something like this. Is it for a swing trade? Is it for a flip? I mean, it's okay. You can buy a leap and sort of target a 3 or 4 week time span in order to get out. I mean, that's fine. Um, that's okay. But for me, the advantage of leaps is to be able to create that exposure for less money and have that nice downside hedge, right? And we have all that cash sitting on the sidelines as well. So for me, it's something that I only use in themes that I really, really like, very, very strong companies. Um, Going back to the sort of foundation of all my programs is, don't get involved, except for maybe a small percent of your portfolio. Don't get involved in companies that you just really don't believe in. This trade is for companies you really, really believe in. So in fact, it's actually the complete opposite of what you'll sometimes hear. I think you want to own these things for the earnings event, right? You believe in this stock. You believe in perhaps the broader economy, et cetera. You believe in a secular theme, whether it's AI or whatever. You want to be involved in this thing at a lower cost with a built-in hedge and being able to keep some cash on the sidelines. So I kind of like that. It doesn't really affect the value of the option. So I think people who say that are kind of confused. They don't really understand how that term structure works. So I'm not saying it never happens, but really it's very, very minimal. Think about it. We just came off of a huge crash, and those long-term options really didn't come down very much. So on an earnings event, it's going to be almost imperceptible. So hopefully that's covered some interesting things about leaps, how I go about them, what I'm really targeting, maybe some myths or difference of opinions. I'm not saying I'm 100% right, but different opinions. And again, it depends why you're using them, right? So you could be using them for a shorter term trade, and that's fine. I've bought leaps and then sold them like 4 days later when I'm up 50, 60% on them. So it's not to say that you have to stick it out with these things, but for a stock replacement type strategy, you really have maybe a different outlook than you would on a quick sort of swing trade type situation. So I think these are really cool. Do you want to wait for the VIX to be here or there? Some people say, well, you only want to buy them when the VIX is over 15. Really, that's neither here nor there. Technically, when the VIX is low, you have very, very strong markets that can trend upwards for long periods of time. I wouldn't say there's any kind of strict rule there. I mean, I'd say they're perfectly fine to buy with the VIX under 15, and I'd say if anything, you kind of anything under 20, they're great. Anything between 20 and 35 on the VIX, maybe if you're trying to time markets a little bit better, which you may not be. Remember, this is stock replacement. You're buying something you believe in. So, but if you really want to time things, maybe that 20 to 35 range for the VIX is one where you want to maybe sit and watch. And then anything above 35, 40 on VIX, you're starting to get a real washout in markets, baby out with the bathwater. And that's often your opportunity to get into names that you've been waiting to go on sale, right? Now you're getting great stocks on sale. So I don't think the rules are hard and steadfast, but absolutely, there are going to be environments, as you learn in my programs, there will be environments where you want to be more careful. And so hopefully you guys enjoyed that. I know that was a long one, but I think it is one of the great strategies out there. And again, look into I'm going to put the Leaps Trader, hedged income trader, down in the description when it's ready, and you'll be able to subscribe to that, and we'll have some monthly deals and a yearly deal and things like that. So have a great day, everybody. See you in the next video.